Imagine buying a house. You wouldn't hand over your life savings based purely on today's asking price. You would check the physical foundation, assess the neighborhood, and calculate the potential rental income. The financial markets operate by the exact same logic. That flashing ticker price you see on your screen is often completely disconnected from reality. It is a real-time reflection of temporary human emotion, panic, and hype. So if we cannot trust the price tag, how do we evaluate an investment? How do we separate a genuine bargain from an overvalued asset that is about to collapse? We have to look under the hood. We use a process called fundamental analysis to calculate an asset's actual objective worth. An asset's intrinsic value is a physical reality. It is grounded in real math and real business operations, existing completely separate from the daily noise of the trading screen. When you buy a stock, you are buying a piece of an actual, functioning business. To see how healthy that business is, we have to read its financial report cards. This document shows the three primary reports: the balance sheet, income statement, and cash flow statement. They detail what a company owns, owes, and earns. At the bottom of the middle column is net income, revealing the actual bottom-line profitability. But finding a profitable company is only the first step. We still need to know if the market is selling us those profits at a fair price. We do this through valuation. This graphic explains the price-to-earnings, or PE ratio. It is a forward-looking mathematical tool that tells you exactly how much you are paying for one single unit of that company's profit. By contrast, we use the price-to-book, or PB ratio. This chart breaks down the three-step calculation for finding a company's book value. The PB ratio measures the stock price against the hard physical assets and actual net worth the company holds today. By weighing both future potential earnings and present physical reality, investors can confidently spot hollow growth and avoid overpaying for corporate hype. Moving into the foreign exchange market, the rules change entirely. Here, you are no longer evaluating a corporate board of directors. You are evaluating the health of an entire nation. Instead of corporate earnings, a country's value is driven by its interest rates and macroeconomic data. We track metrics like GDP growth, consumer spending, and inflation numbers to gauge total economic fitness. Controlling this massive system are the central banks. Institutions like the Federal Reserve act as the ultimate referees, dictating the money supply and literally setting the price of money through interest rates. A single policy speech or a subtle shift in tone from these central entities can violently alter the strength of a currency in seconds. Ultimately, the price tag of a fiat currency is simply a real-time measure of global trust in that specific nation's economic stability. Cryptocurrency strips away traditional structures entirely. There are no corporate balance sheets to read, and there are no central bank referees managing the system. Instead, we evaluate tokenomics, the economic rules coded directly into the asset. Verifying the total maximum supply against the current circulating supply is the only way to protect against massive dilution. We also have to check wallet distribution. This chart shows a token breakdown where large allocations are heavily concentrated among development teams and major backers. If insiders hold too much of the supply, they have the power to easily manipulate the market price. Next, we look for network usage, the digital equivalent of a foot in a shopping mall. A blockchain might have a high token price, but if it lacks active wallets and developers building apps, it is essentially an empty building. Social media hype and influencer sentiment can temporarily pump a digital token's price, but true network adoption and sound tokenomics are the only metrics that guarantee long-term survival. Across stocks, national currencies, and digital tokens, fundamental analysis serves as our most reliable tool for cutting through market noise and verifying true value. But these metrics cannot be used in a vacuum. A low PE ratio might indicate a bargain, or it might signal a dying business. A blockchain with high transaction volume could simply be full of automated bots. Context is mandatory. There is a clear operational boundary here. Fundamental analysis tells you exactly what high-quality asset is worth buying. Technical analysis, using charts and price patterns, tells you exactly when to execute the trade. The most effective traders do not guess based on a flashing ticker. They demand concrete mathematical proof of an asset's underlying value before they ever sit down to negotiate the price.